This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Game on. Dow component Nike beats Wall Street earnings expectations on strong demand, but there are a couple of numbers in the report investors should watch.
Lifting the ban, Congress hears testimony on the benefits of exporting crude as oil prices remain volatile and under pressure.
And deadline looms, and for many retirees, if you miss it, it could cost you. All that and more tonight on Nightly Business Report for Thursday, March 19th.
Good evening, everyone. Stocks took a breather, pulling back from yesterday's big Federal Reserve-fueled rally. But we begin tonight with earnings from the world's largest soft sportswear maker, Nike. The Dow component reported a 16% jump in quarterly profits as more people bought apparel and running shoes. The company earned 89 cents a share, a nickel better than expectations. Revenues were hit by the stronger dollar and came in below Wall Street estimates at nearly $7.5 billion, but that was an increase from a year ago. Shares initially moved higher after the report. Sarah Eisen has more on what's working for Nike and what's not.
The takeaway for Nike, when you're a global consumer giant, it helps to have a strong and growing brand to help counter the negative impact of the stronger U.S. dollar. And that's exactly what Nike saw. Overall, the numbers were solid from apparel to footwear, but sales missed the mark because of that stronger U.S. dollar cutting into Nike's sales abroad. North America is its biggest market, but it does do most of its business overseas. Futures orders are what everyone pays attention to when it comes to Nike numbers. The company is expecting them to grow 2%. Take out the impact of the stronger dollar, and that number would have been up 11%, driven by strength in North America, in Europe, Japan, even double digits in China. The only sour spot in terms of the outlook was for emerging markets. The bottom line, Nike's underlying business is strong. It's been investing in new product launches and innovation, and that is helping cushion it from what is a major headache from corporate America right now, the stronger U.S. dollar. For Nightly Business Report, I'm Sarah Eisen.
On Wall Street, it was a day of reversals. Stocks were down after being higher yesterday. The dollar rose after yesterday's fall, and oil prices dropped, weighing on energy shares. And Dow components like Chevron and ExxonMobil. By the close, the industrial average fell 117 points to 17,959. That's the ninth triple-digit move in the past 10 sessions. NASDAQ moved higher, gaining 9 points. The S&P 500 sank 10. And on its first day of trading as a Dow component, Apple shares were a little bit lower by almost $1. And initial jobless claims rose marginally last week, increasing 1,000 to a seasonally adjusted 292,000.
And now to oil, where Congress today held a hearing on whether to lift the current ban that prevents exporting that commodity. And the hearing came on a day where supply concerns weighed on prices. By the settlement, West Texas crude fell 70 cents to $43.96. Jackie DeAngelis has more on the downward pressure on prices and the hearing on Capitol Hill.
Oil prices seeing red this week on the back of a stronger dollar and a supply glut that continues to grow. Wall Street analysts have been predicting that we could see $30 oil in the first half of the year, and even traders that were skeptical now agree. This week, the EIA reported crude oil inventories grew again by almost 10 million barrels. The agency also saying that U.S. supplies at the end of February were the highest since the mid-1980s. And today, OPEC reiterating that it has no plans to alter its production strategy as it struggles to maintain its market share.
It's really not about demand, it's about how quickly supply is ramped up. The oversupply of OPEC and their continuation to not cut any production and to pump as much as they can so they don't give up any market share has been a real main factor as to why we've gotten down to the low 40s.
On the back of supply concerns, Washington is debating whether to end the decades-old ban on global oil exports.
Crude oil is the only energy product banned for export, and that needs to change.
Industry insiders believe global political concerns will keep the export policy changes on hold for now. But supporters like ConocoPhillips chairman Ryan Lance believe exports could be a bright spot for the economy.
On average, 400 to 800,000 new jobs per year. We'd gain 86 to 170 billion in annual GDP.
To add insult to injury, storage space is filling up quickly. Current estimates suggest that we're roughly 60 to 80% full. Should that number rise to near 100%, it could be the catalyst that crushes oil.
We think that we will get a spike downward once we get closer to 100% full, because everyone will be forced to glut the market with oil in the cash market, and that will send the prices down.
Then there's the impact of the strengthening dollar. It takes traders using other currencies out of play, pressuring prices. If the dollar continues its monumental rise as expected, that is bad news for oil prices. It means they could slide further. For Nightly Business Report, I'm Jackie DeAngelis.
With the drop in oil prices, some investors may steer clear of buying stocks in the sector. But as Morgan Brennan explains, there are investment opportunities to be found if you know where to look.
As crude oil prices renewed their slide, energy stocks followed suit, with the energy sector the worst performing in the S&P 500 today. But as oil continues to fall on oversupply concerns, experts are beginning to return to the stocks, drilling for deals in a sector that's shed nearly 20% since September.
We see some good opportunities in energy right now, and frankly, I think the price is unsustainably low for crude oil. So, we are advising investors to make long-term investment decisions, and over the long term, say you have a year plus time horizon, we think it is a good time to buy energy stocks.
One group that's already reaping returns, refiners, which haven't just outperformed other energy stocks, but the S&P as a whole this year. Why? Oil refiners benefit from lower U.S. crude prices, which mean lower costs. The resulting petroleum products are then sold at prices tied to Brent crude, the international benchmark, which is valued higher. Experts say it's not too late to get in on the rally.
For an investor that's willing to deal with a little more commodity price volatility, we do like the refiners, specifically Phillips and Valero. We think that they are not pricing in current spreads, so we see upside in these stocks.
But analysts are also beginning to warm back up to oil and gas producers, so-called exploration and production companies, that have been among the hardest hit by crude's collapse. Companies like Carrizo Oil and Gas, a smaller producer that analysts note is likely to buy more acreage, a move that would position it for growth in the long term once oil prices recover. And with crude inventories at a record high and growing, midstream companies that own pipelines and storage tanks stand to gain as well. Energy infrastructure giants like Enterprise Products Partners, Plains All American Pipeline, and Magellan Midstream Partners, which pay out hefty dividends and are busy expanding their holdings. But there are still plenty of headwinds, and one of the largest is the fact that oil could move much lower, at least in the short term. That means plenty of volatility for energy stocks, and it also means greater risk. For Nightly Business Report, I'm Morgan Brennan.
Banks that have issued loans in the oil sector face millions of dollars in potential losses. In a report published by the Wall Street Journal, big banks like Citi or Goldman Sachs and UBS thought they'd be able to sell those loans to investors, but they haven't been able to due to the decline in oil prices over the past 9 months.
Now to Europe, where heads of state are meeting in Belgium to discuss Eurozone economic policies. But the main focus was Greece and its precarious financial situation. Julia Chatterley reports from the EU summit in Brussels.
The vague hope coming into this EU leaders summit in Brussels was that the Greek Prime Minister Alexis Tsipras and Germany's Chancellor Angela Merkel could put aside their differences and thrash out some kind of interim solution to help Greece meet its debt repayments and its wages and salary bills at the end of this month and beyond. Those hopes were dealt a swift blow early on. We heard from Angela Merkel saying that there will be no solution, that ultimately it comes down to the individual finance ministers to reach a deal. The second blow came in the form of reports suggesting that the European Central Bank was going to become even more tough on the Greek banks, a real trigger point for stress in the economy. And we saw the reaction in the Greek debt markets yield significantly higher over the course of the session. Ultimately, both leaders have their hands tied. Angela Merkel's hands tied by German public sentiment. We've seen a real shift even in the last few weeks. One recent survey suggesting 59% of the population willing to see Greece leave the Eurozone. And if we look at Greek Prime Minister Alexis Tsipras' position, he's also bound by the promises that he's made to the Greek people. We've been talking about these for weeks, but also the deal that he signed just over a month ago when he said without reforms, without implementation of their reforms, there will be no cash. This is where the situation remains. The clock still ticking on Greece's economy. For the Nightly Business Report, I'm Julia Chatterley in Brussels.
Still ahead, a key tax deadline is looming, and if you miss it, it could cost you a lot. General Motors CEO Mary Barra will be deposed over defective ignition switches. Barra will testify under oath in October, along with other current and former GM employees. In addition to the litigation, the automaker is under investigation by the Justice Department. It could result in a fine.
In a rare display of bipartisanship, House Speaker John Boehner and Minority Leader Nancy Pelosi say they are close to fixing a long-standing problem surrounding how Medicare pays doctors. For years, Congress has passed temporary patches, overrides, so that physicians don't take a major cut in reimbursements. Now, this deal being hashed out would make a fix permanent.
I'm encouraged by the progress our committees are making to permanently resolve the so-called doc fix. As you all know, we've had to patch these doctor payments 17 times over the last 11 years. I've been committed to finding a permanent solution to this problem. It's a chance to get rid of Washington's most infamous budget gimmicks. But it's also an opportunity to make structural reforms to Medicare that mean better health care for seniors and real savings for taxpayers.
Well, the deal isn't done yet, but the April 1st deadline to do something is fast approaching.
The government has recovered more than $3 billion from companies and individuals that tried to defraud the government-run health programs like Medicare and Medicaid. That's according to a report from the Departments of Justice and Health and Human Services. The administration has recovered $7.70 for every dollar spent investigating the abuse in the past 3 years. The number, though, is still small compared to the tens of billions of dollars the FBI says is lost each year to healthcare fraud in this country.
It's been called one of the most important events for the entire biotechnology industry this year. Tomorrow, the company Biogen Idec will shed light on its experimental drug for Alzheimer's disease. Since initial results of the drug were released in December, shares have shot up in that company 40%. Meg Terrell takes a look at what to watch for and what's at stake.
Biogen shocked everyone in December when it reported initial data from a small study examining the safety of its experimental Alzheimer's drug. What people didn't expect was that it would show signs of working as well. Tomorrow, additional data from the study will reveal just how strong the drug looks.
We've had a few fits and starts here with Alzheimer's drugs. This class especially have had a couple of fairly high-profile, call it failures. But I think what's got folks really excited is perhaps that this time it's a little different.
Biogen's drug, known as BIB37, appeared to clear the amyloid plaques in the brain associated with Alzheimer's disease. It also looked to stem declines in cognition, in memory, and thinking clearly. Biogen said on the strength of the results, it would move the drug quickly into phase 3 clinical trials, the last stage before applying for approval. Analysts say a successful drug could mean big business. Alzheimer's disease affects more than 5 million people in the U.S., a number expected to triple by 2050, according to the Alzheimer's Association. It's currently the 6th leading cause of death in the United States, and there are no drugs on the market shown to slow the disease's course.
I would say even with reasonable penetration numbers, this could, with a straight face, be a $10 billion drug.
That's $10 billion a year. Analysts are also looking closely at the drug's safety. It did show a side effect known as ARIA, or amyloid-related imaging abnormalities. That's tied to removal of the plaques in the brain. It'll be important to see if Biogen can administer the drug at high enough doses to work without raising safety risks. The stock has already risen almost 40% since the first data came out in December, and analysts say we could see big swings tomorrow. Eric Schmidt at Cowen estimates the stock could drop 20% if the data are very disappointing, though he's optimistic about the results. He says the stock could gain 15% if the results are stellar, making this one of the most anticipated events for the entire biotech industry this year. For Nightly Business Report, I'm Meg Terrell.
To read more about Biogen's experimental Alzheimer's drug, head to our website, nbr.com.
Lennar's results signal a pickup in the housing market, and that's where we begin tonight's market focus. The home builder saw a rise in deliveries and prices, helping results despite severe weather, which weighed on sales in some parts of the country. New orders also increased, which is a positive indication of the company's future performance. Still, shares fell a fraction to $49.65. Michaels posted earnings and revenue that beat during the holiday quarter, helped by the popularity of do-it-yourself projects. The craft retailer's CEO says social media is helping to drive business.
When you think about the digital aspect about being inspired through social media and Pinterest or Facebook, or the marketplaces like Etsy, or online education where people want to learn how to personalize and customize something, which is really the business that we're in, the digital arena really plays well to Michaels.
The company's profit outlook for the year is a bit soft, which it's blaming on currency issues and West Coast port delays. Still, the stock closed a fraction higher at $29.42. Hewlett-Packard is hiking its quarterly dividend again, this time by 10%. The new payout of 18 cents a share has a yield of about 2%. Still, shares of HP were down slightly to $32.84.
Nucor lowering its first quarter earnings forecast because of a high level of steel imports. That's pushing prices down. The company expects imports to slow down in the second quarter, but still remain at high levels. This is the stronger dollar has made imports cheaper, and steel from China has flooded the market. Shares tumbled more than 6% today to $46.10. Shares of Yelp tumbling today after a documentary trailer was posted on a fundraising website, Kickstarter, that accuses the company of extortion. The film, called $Billion Bully, suggests the company features negative reviews for businesses that do not pay to advertise on Yelp. Shares were off 3.5% to $45.18. Regulators have decided that Bank of America must allow shareholders to vote on whether the bank should form a plan to break itself up. The proposal comes from a member of a consumer advocacy group and calls for an independent director panel to develop a plan for divesting all of the bank's so-called non-core businesses. Shares of B of A down more than 2% today at $15.61.
And now to our segment on the tax deadlines. An important date is approaching for people required to withdraw from their retirement accounts, but many could miss it because this is not the time of year generally that many retirees and investors are focused on their retirement savings. But Tim Maurer says not doing so could have some expensive consequences. He is Director of Personal Finance with BAM Alliance and a member of the CNBC Digital Financial Advisors Council. Welcome, Tim. It's nice to have you here.
Great to be here. Thank you very much.
Let's start, first of all, with there's some deadlines that are looming out there that people may not be aware of, and one of them has to do with people who are turning basically 70 and a half. Tell us about that.
Yeah, Susie, if we have saved in 401ks and traditional IRAs for most of our career, hopefully we get the tax benefits of a tax deduction and tax deferral over that time. But the government wants that money to come back out of those accounts so they can reap the tax benefits when we retire. Once you reach age 70 and a half, I cannot explain why the half number, but once you reach age 70 and a half, you're forced to take money out of your retirement accounts. It's known as a required minimum distribution. You should be taking your required minimum distributions by December 31st each year. However, in the very first year after you turn 70 and a half, they allow you to delay your first required minimum distribution until April 1st. So this serves notice to anyone out there. If you turned 70 and a half, you might have to do a little math there to figure out exactly when that was, in 2014, if you have not yet taken your required minimum distribution, you still have until April 1st to do it, and that's extremely important because the penalty for not doing so is 50% of the amount that you were supposed to take out.
50% of the amount you were supposed to take out, not 50% of the balance in the account. This applies, Tim, to 401ks, 403bs, 457s, IRAs, Roth IRAs, rollover IRAs, SEP IRAs, right?
Not everything. The one that you mentioned to which it does not apply, Tyler, is the Roth IRA. One of the key benefits of a Roth IRA is that you actually do not have to take required minimum distributions, and especially since Roth IRAs allow your money to continue to grow and be deferred tax-free, it's one of the reasons I especially like the Roth IRA.
So, Tim, are there exceptions? There always seems to be an exception to every rule. Are there exceptions in this particular rule or not?
There are, Susie. One is that if it's your 401k we're talking about and you're still working for that company and you don't own over 5% of it, believe it or not, then you could not take required minimum distributions from that 401k. You may, however, still have to take them out of your traditional IRAs. The other exception is the Roth IRA. You do not have to take a required minimum distribution if it's your original Roth IRA. If it's an inherited Roth IRA, there again, another exception, you will have to take a required minimum distribution. The exception to the exception.
So how do I know how much I have to take out in a required distribution? Who tells me, or do I calculate it myself?
Well, you can calculate it yourself, but I highly recommend you allow your custodian to do it. That is your Fidelity, your Schwab, your TD Ameritrade, whoever it is, the broker-dealer that handles the custody of your retirement account, they would calculate it for you. You may still want to double-check it with your CPA, do your own math. The very first year you take a required minimum distribution, it tends to be about 1/26th of the account value, and then each year that you age, that percentage increasingly goes up.
You know, Tim, how many people do you think actually know this? I mean, how much money are people really losing by not knowing this?
Well, the good news, Susie, is that this has not been a particular area of enforcement in the past. But as we've been hearing for the last several years, the IRS is really stepping up enforcement efforts. So my hope is, quite frankly, that this rule becomes more sensible at some point in time in the future. That, I think, will help retirees make better retirement decisions and tax decisions.
On that optimistic note, thank you, Tim. Nice to see you again. Tim
My
Maurer.
pleasure. Good to see you, too.
Ty?
And coming up, for some small businesses, getting a loan can be tough, but now some owners are starting to think outside the box and outside the bank to get funding they need. Recall news to tell you about. Honda adding 105,000 cars to its recall list to fix potentially deadly Takata airbags. At least 5 deaths have been linked to the malfunctioning airbags in Honda products. This brings the total number of recalled Hondas and Acuras to 5.5 million.
A judge has okayed a $10 million offer by Target to settle a class action lawsuit related to its massive data breach in 2013. That's according to reports that were out today. The retailer will pay individual victims who had their information stolen and suffered losses up to $10,000.
Getting a small business loan can still be tough, even though the economy has improved. Some banks just don't want to originate loans under $1 million, but the void is now being filled by non-traditional lenders. And as Sharon Epperson reports, that helped one small business owner finance his company's rapid expansion.
There's a specialty coffee craze brewing in New York City, and Joe Coffee is at the forefront of shops that are picking up steam.
Once they discover you, once they sort of become part of your following, they won't go anyplace else. They find a way to go to Joe 7 days a week.
Joe Coffee owner Jonathan Rubenstein says his business has a loyal following, and that has enabled this family-run enterprise to expand to 12 locations in just 12 years.
12 years ago, we really started by borrowing money from family, from friends. We would give people little pieces of the business in exchange, or we would just borrow money and give them interest.
But at some point you had to say, okay, I've tapped all my family, my friends, everybody's invested in this. I know you still have family members who are investors. So for money, eventually you have to go outside and look at lenders.
That's true, and that's where I turn to our COO and say, we want to do a new shop, go raise the money.
Brandon Wall, Joe Coffee's COO, opted not to use a traditional bank to secure financing.
When we're looking at a new location, we want to get that lease signed before one of our competitors signs it. We can't spend a month and a half or 2 months going through the traditional loan process with a big bank.
Small business lending has been slow to improve even as the U.S. economy recovers. But there's a new crop of lenders that are filling the void. They're making loans of less than $1 million to entrepreneurs who are looking for a faster alternative to financing their business, just like Joe Coffey.
So there are a handful of different structural problems which make it difficult for banks to finance the small business community. On the one hand, with Basel III requirements, they're forced to hold more capital on their balance sheet for smaller loans. So often it's more profitable for them to make larger dollar loans to bigger businesses than it is to make thousands of smaller loans to smaller companies.
Even for small businesses that are healthy, profitable, and growing, trying to get financing is a challenging place to be, which is why Joe Coffey decided to go with small business lender Bond Street to finance its 11th location.
If you see a space that's great and you want it, you need to be willing to commit and have the money in the bank.
In 6 business days, we were able to get $200,000 to open our 11th location.
And now Bond Street is helping Joe Coffey finance another location. And speed is key. It's that quick access to capital that's giving a major jolt to small businesses like Joe Coffey. For Nightly Business Report, I'm Sharon Epperson.
Interest rates on the loans offered by these non-traditional lenders are comparable to those offered by banks on the low end, but the range is much wider. For example, the interest rate on a bank loan could range anywhere from 5 to 10%, but could go as high as 20% from a non-traditional lender.
And that does it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Matheson. Thanks from me as well. Have a great evening, everybody, and we'll see you back here tomorrow.